Hi traders, welcome to this video. Today I want to talk about gap ups and gap up trading or entry a trade after a gap up. A lot of people are scared by gap ups because the stock is moving higher on a very strong price move, and a lot of people have problems to buy new highs or to buy on strength, and a lot of people have concepts in their mind that something is overvalued or undervalued. I personally don't think in such terms. You know, the market is telling me a price, and the market is evaluating a stock in real time. And if the market thinks, okay, the price is now 20% higher for the company, or the market capitalization is 20% higher, and is doing that aggressively within gap up. I don't want to speak against that. I have to accept what the market decided. And I want to go with you through some candidates here in this video, and I want to show you some gaps and how to trade them. Okay, the first candidate is Amazon some time ago, and here you can see a first huge gap up here. And you can also see some things where I look at and what I want to see if I buy on a gap up. The first thing is, the first thing you have to think about is, what is a gap up? A gap up is the difference between the yesterday's close and the today open. And sometimes, there is a gap between those both prices, and the gap is always a sign of extreme demand or extreme distribution. So extreme accumulation or demand on the upside, and extreme supply or distribution on the downside. And these gaps are created by large orders which are coming into the market, and create the first price at the opening where the demand can be fulfilled. And the demand is mostly created by institutions which are buying aggressively into a stock and open complete new positions in their funds, or add aggressively to their existing positions. And in most cases, the gaps are created by news, maybe, for example, earning reports or good news about the company. And I personally trade gaps because they are showing me very clearly that there is a very high demand for the stock. And I also trade gaps on earnings reports, but you have to make sure that the stock is really ready to move up after the gap. And this is very important. And you can see here in Amazon, you can see there is a sideways consolidation about a few months, where the stock is going sideways, and then the price opens above this 1050 level, so around price mark, and also above all these highs. And we traders call such a situation a breakaway gap, because the stock is breaking out, and it's breaking out on a new all-time high, and it's breaking out of this pattern, out of this consolidation. And this is a first thing I want to see. I want to see a multiple month consolidation. Otherwise, I'm not buying a stock on the breakout. And the breakout must happen in a stock with very, very good fundamentals. So you must require that the stock has great sales, great earnings, is in a high demand from institutions. It must be, or it must have some institutional support, and you must always make sure that there are a lot of people behind you which are buying through the whole day. And the second thing I want to see is volume. I want to see huge volume, and I want to see huge volume in the first minutes of the session. So if I look at the first 30 minutes bar, for example, on such a gap day, and I see that the volume bar for the first 30 minutes is the highest for weeks or the highest for even months, then I see that there is a huge demand inside the stock or for the stock, and then I'm more willing to buy a position. And I'm also observing the price through the first 30 minutes or 1 hour and see how the price reacts, and then I'm starting to buy a position. I personally don't buy a position at the open. I always want to see what is the price doing, and sometimes I chase a little bit the stock, but that's okay. And chasing is not bad in general, because chasing gives you also confidence and gives you information that the stock is really in demand. The second thing, or the third thing, is you want to only buy breakouts in an uptrending market. You don't want to buy breakouts in a downtrend. You always want to trend with the general stock market. And also a very good sign is, of course, that the relative strength here on the breakout confirms the price breakout and is on a new high here. And in such a situation, you don't have to buy the full position. You can go, or you can scale into the trade slowly. For example, buy the half position you planned and then buy more through the day if the price is going up, or buy some more shares at the close. I personally mostly buy in 3 chunks. So I buy 1/3 or a half position as an initial position, and then I add to the stock when it's going up. Okay, let's look at another trade, NVDA, and I think it was in 2018. 2017 here, and 2017. I have the situation clear in my mind because I traded that, and you can see here the same pattern. You can see there is a consolidation over a few months. We traders call that flat base. So this is a flat base, and then the stock broke out, and it was also I think it was earnings release, very good earnings release. The stock was in a clear uptrend. It was a large leader and a true market leader, and you can see that the volume decreased before the price broke out here, and then you can see this large volume. And sometimes you can see that the 50-day average volume is traded in the first 30 minutes. And on such a day, you can see that here that's 400% of the average daily of the 50 daily average volume. So it's a lot of demand which is coming here into the market, and then you buy a position, and you can buy it when the stock break out above this red line, and then you can add on a next day and complete your position. I always make sure that if I want to buy such a stock, I have a small stake in the stock. And where should you place your stop loss? Of course, the easiest way is really to put the stop loss below the low of the day. So in that case, you're around 7%, which is absolutely acceptable for me. Sometimes you have to put your stop loss maybe 8% away, or maybe a little bit more than, but in that case you have to decrease your position size and maybe can move the stop loss up on the next day when you buy more shares and complete your position. Okay, another gap up. I traded last year was on DXCM, and I was a little bit in doubt about DXCM because the consolidation you see here is not ideal, it's not perfect. You see that there is something like an upward consolidation, but what you can see on this breakout is that it also broke out above this upward consolidation. So the first price, which was where the stock was traded, was above this red line and above this high here. It was a new all-time high. The stock broke out on earnings release. Very good fundamentals. I bought into the stock very early, so after the first I think it was 30 minutes or to 1 hour, and the stock was already up a few percent, and I bought into it, and I bought another position the whole on the same day and the rest on the next day. And you can see the same thing here. Monster volume is coming into the stock, so a very, very high demand. You can see that normally the stock is traded 880,000 shares a day, and on that day the stock was traded 7 million, so nearly 10 times the average volume. That's huge demand. And then you can see that an uptrend started, and then the market, or the general market correction came, and you have to exit the stock in that situation. Another stock where we can look at is STAA, and STAA, that was in 2018. Here you can see this monster volume day. This is really monster volume, and that was normally the trade was traded around 200,000 shares a day, and on that day the stock was traded 4 million, so 20 times the average volume. Monster demand. And you can see a very similar pattern, something like a flat base here. Stock was only gapping up a little bit and then start to run the whole day. And in that situation, you also can buy the breakout here, put your stop loss below the low of the day, and then let the stock run. You can also see that STAA, for example, the market was not in an uptrend here. It was in a long-term uptrend, but not in a short-term uptrend. But you can see that the market was coming out of correction, which is also a great situation, and started a new uptrend. And that's also a situation where you want to buy stocks, so very early in a market uptrend. And then the stock did another thing, and this is a warning sign. It gapped up a second time. And you must always have in mind, the first gap up is really good. The second one is buyable in only a very few cases. The third and the fourth gap up you have to avoid. because in that situation, every institution already bought. Aggressive buying is only good in the beginning of an uptrend. It's not good if you see it after the stock rallied for a few weeks or a few months, because in that situation, it also signals exhaustion. And you want to avoid exhaustion. In such a gap up, I maybe be a seller and not a buyer, because I already bought here and I sell a portion of my trade in that situation. And this candle here, or this bar, gives you another clue. You can see that the close was in the lower half of the day on that gap up. And in that situation, I don't want to buy such a stock. If I bought such a trade, I will sell it, or at least sell a half position at the close, because I want to reduce the risk in that situation. I have another example of multiple gap ups in a row, and this is Cardlytics. Cardlytics, you can see that has some very, very strong accumulation days. So you can see it here. So very good signs, or very clear signs of a high demand in the stock. And then you can see that was the all-time high. And then you can see that the stock gapped up to a new all-time high. That was the case here. And if you did not buy earlier, this was a great buying signal, because the stock gapped up to a new all-time high. There was a consolidation before, not the same consolidation as in the cases of Amazon or NVDA or DXCM, but you can see there was a consolidation. It was a very young stock. It was an IPO with great fundamentals. You have a huge demand for the stock, and then it broke out to a new all-time high. And in that situation, you can see also the stock had good volume on that day, and in that case you can buy the stock also, because here was a consolidation or the breakout line. In that case, the stock gapped up, run higher, made a new all-time high. So everything, good signs on your list, which shows you that the stock is in strong demand. And and it was also a young trend. I mean, the trend here started in May, and that was August, so around 3 months, and we had a young bull market in that case here, after this big correction here in 2018. And and then the stock ran higher and higher, and then the stock did something which is a warning sign for me. The stock gapped higher again, and it gapped a third time, and this is excessive. This is not normal, or this is not the behavior you want to see, because you must always have in mind, institutions are buying aggressively into that stock. So, and on a given time, the demand is fulfilled. There is no demand for the stock left. They all bought their positions. And the longer a trend, the longer a stock rallied, and the more demand or aggressive buying is shown in an uptrend, the more or the less the demand get, because the demand is fulfilled, or is more fulfilled on every gap up. And that's why you don't want to buy late in a trend, and don't want to buy late gap ups. And you can see that here on the first gap up, you have very high volume. Then here it's the highest volume forever. So that's a clear sign that all the traders are buying aggressively in the stock. And then you can see the last gap up has a lower volume. So the demand for the stock was lower. So the appetite for the stock is not high as in the beginning of the trend, and then the stock topped. And in such a situation, in the last gap ups, you want to be a seller. You don't want to buy into such a situation. And if you look at that situation here, the stock was already up 300%, and that's not what you want to see. That's not where you want to buy. This is not a new fresh trend in that situation. And in that situation here, the trend was only up 130%, which is, it's not so much, but it broke out to a fresh new all-time high in that situation. That was the beginning of the trend, and that was the middle of the trend, and that was the end of the trend. You never know this before you get into a stock. You only know this in hindsight, but you must have in your mind that trends are not lasting forever. They will top at a later stage, and you also can use the stage model. You can see that, or you can say, okay, this here was first stage, this was a second stage, that was a third stage, and never buy into a trade on the third stage. Here, if you buy the second stage, it was okay, I would not do that, but on the third stage, never buy it. That could be a fair breakout. Okay, I want to give you a recent example, and this is LVGO. And LVGO, you can see it gapped up here on the 7th of April. And it gapped up through 3 pivot points. So first high, second high, and third high. And it gapped up to a new high here in that consolidation. So very nice consolidation, one of the strongest stocks in the market, very good fundamentals, good volume, everything I want to see. And it was able to hold the breakout here, and closed in the upper half. And I bought into the trade. I bought a half position here, and I bought the rest on the next days. And that situation is maybe a little bit special, because you can see the trade was already up 80% here, or 75%. But if I look at that here, it shows me one thing, and this is institutions are willing to pay more for the stock, and they are buying aggressively. They don't look at charts and they don't say, oh, I want to buy it on a pullback or something. No, they click the buy button and say, bring me into the trade. And they are buying aggressively because they want to build a position in that stock, and they don't want to build a $10,000 position or 100,000. They want to maybe build $1 million or 10 million position in that stock, and they don't fight for pennies. And I always have in my mind, if I buy such a stock here on a gap up or breakout, I always have in mind the next support level. In that case, this red line here, the breakout line, should hold on a retest. And you can see that it's true. In that case, the stock or the price pulled back to the breakout level here for 2 days, and then go up again. And this gives me confidence. Because I see that other people are willing to buy the smallest pullback here on this red line. And you must always, or don't think in fixed mindset or in a fixed trading situation. You must always have a dynamic mindset, and always have in mind you want to test the hypothesis if the trade is right. You know, if I go into such a trade, I always have in my mind, I want to check with my trade if the stock is able to hold the breakout level until the end of the trading session. This is my hypothesis. And if this is true, then I can buy more because it gives me confidence that my hypothesis is right. And this is what I personally have in my mind when I buy breakouts. If I buy breakouts, I have the expectation that the stock will close strong. And if that is not the case, my expectation was wrong. And then in that situation, I start to be defensive and start to scale back and also sell shares. And that's important on breakouts. To sum it up, it was maybe a little bit long and also complex, but to sum it up, you want to see a stock which is in a clear uptrend. You want to see a market which is an uptrend or turning into an uptrend. You want to buy into a stock which show you great fundamentals, great technical strength, so where institutions are willing to buy the stock. You want to see a high relative strength, and you want to see extreme volume on a gap up day. And of course, a very clear and a very simple chart pattern and pure strength, something like a new 52-week high, a breakout out of a sound chart pattern, or a new all-time high. I can give you a tip if you want to do that, or if you want to get familiar with buying gap ups. Go small. Only buy a small position on the gap up. Only 2.5% of your capital, 3 or 5%. That's enough. So, but buy into a gap up and try to learn to look for the small details on gap ups. Go through historical charts and analyze every gap up you find, every big gap up, not the small ones, every big gap up, and also learn how to recognize gap ups which fails. So that's what I can recommend for you. I hope this video helped you to understand my thoughts and my process around buying gap ups. And you can follow me on every social media platform, from Twitter, Facebook, and of course here on YouTube. And I also recommend my free newsletter. Every Sunday I send trading tips to my subscribers, and also 4 candidates from my watch list.